Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney.
And I'm Molly Smith, filling in for Alex Steele.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at how the 737 MAX crisis impacted Boeing's quarterly earnings.
Plus, we'll discuss how cost cuts impacted earnings at UPS.
But first, we kick off a big week of corporate earnings with the electric vehicle maker Tesla. Tesla reported quarterly profit that fell 48%. Sales also fell 9%.
And this comes as the company has spent more than a year slashing prices across the lineup in an effort to boost sales. And after Tesla reported results, CEO Elon Musk vowed to launch a less expensive vehicle as soon as later this year.
For more, we were joined by Stephen Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst. We first asked Steve for his reaction to Musk's comments.
I think the affordable EV is a real thing. Robotaxi, I think there still needs time for development. But if you look at the affordable EV, it actually kills two birds in one stone. You know, it actually increases the scale for Tesla. We're going to see revenue growth. We potentially see profit growth from that affordable EV. And that's exactly what the market needs. It's more affordable vehicles to increase penetration of EVs. The other thing that's really important with this affordable EV launch is it actually helps Tesla increase its reach globally, because you have a lot of emerging markets that a lot of consumers there cannot afford an expensive $50,000 vehicle, $40,000 vehicle. So a sub $30,000 vehicle is the right product for them to expand geographically.
Steve, what do we know about the economics of such a new or lower cost vehicle? Can they produce that at a profitable basis on a per unit basis?
Yeah, there's a couple ways they can approach this. I think they can develop a totally new platform. But in the other segments I've done with you, we've talked about vertical integration. And vertical integration has actually reduced the cost of car production. So for them, for Tesla, it's the only company that's profitable in producing EVs. So the other option is actually think about what they can do with the 3 and the Y. Can they offer lower trims, maybe even a smaller battery that's going to allow them to cut costs and also make that available to the consumer at a lower price.
So this obviously was the best part of the report, but you still had elsewhere in the earnings report, we had falling vehicle sales, we had worse than expected revenue and profit, and a pretty significant cash burn figure. So, Steve, are you totally optimistic here, or what kind of concerns do you still have here?
I've always said, I think this year and even into next year, there's some bumps on the road. Cybertruck is still ramping up. It's a very difficult vehicle to build. They're still working on those issues. We don't think the EV market, actually, especially in the US, will pick back up until 2025, late 2025 into 2026, because the market really needs a lower cost, more affordable EV to entice kind of more new buyers into the market. I'm very positive. I think this company has done everything right in terms of looking at AI, looking at AV. I still believe the EV shift has actually sailed. We're going to have EVs, and I think that subscription-based, software-based vehicle that they're trying to build is the right move, right strategy for the industry.
Steve, what did Elon say, or to what extent did he address just kind of the developments in China, how things are developing there from a competitive standpoint, a sales standpoint, and all that?
Yeah, I actually see that it will continue to be bumpy. They're probably likely to lose market share, continue to lose some market share there. But I think Tesla is leveraging China not just for sales, but it's a low-cost manufacturing base for the company. The Shanghai factory still pumps out 1 million vehicles, close to 1 million vehicles a year, at a very low cost. They still are able to source battery from companies like CATL, the largest EV battery maker in the world, at a very attractive price, given their volume. So, China sales will probably slow. It's a hyper-competitive market. Xiaomi, which is a major cell phone maker in China, they're launching a vehicle that's also very affordable. So they're going to see more competition in China. So, but again, China is not just for sales, it's a low-cost manufacturing base for them.
Elon had took a dig at the car makers that are paring back on the EV production plans and going more to the gas-electric hybrids instead. He didn't call them out, but GM and Ford are among those ones. But isn't that really where consumers are going more proportionally right now, more into the plug-in hybrid space, or maybe non-plug-in hybrid, but just hybrids in general versus full-on EVs?
Yeah, I think the consumer, we did a survey not so long ago. I think what we got from that survey was that I think the consumer needs to try out EVs. They actually needs to be educated on how to make EV work in their daily life. So PHEVs, plug-in hybrids is actually good transition into full EVs. They alleviate some of the concerns in terms of range, in terms of the lack of infrastructure that's for the EV market right now. So PHEV and EV are a good transitional product, but it's not a long-term product, because if you look at some of the emission standards, it's continue to be tighter and tighter. Eventually, hybrids and PHEVs probably won't even meet the more stringent emission standards down, in the next decade.
Our thanks to Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
All right, now we're going to move to the software space. This week we heard that software giant Salesforce's talks to acquire the data management company Informatica have fallen through. We were told that Informatica said it's not engaged in takeover talks.
The deal would have ranked among the largest ever by Salesforce. For more on this, I was joined by Anurag Rana, Bloomberg Intelligence Technology Analyst, and Sunil Rajopal, Bloomberg Intelligence Senior Software Analyst. I first asked Anurag for his reaction to the news.
Yeah, it was just a big head scratcher for us too, almost, because last March, Benioff comes and says, I've disbanded the M&A committee, no more M&A, I'm going to focus on margins and organic growth. And in less than a year, just around that 1 year mark, he's like, oh, we're going to go back and, buy something. Now, he didn't say that, the company didn't say that, but that was the rumor on the street that they're looking to buy Informatica. For us, that was a bit of a surprise, because Informatica grows 6 to 7% compared to Salesforce, which is growing north of 10%. So why would anybody buy something that is slow growth? I get the data angle of it, but it was not something that we really liked.
Sunil, tell us about Informatica. I don't know a lot about it. I don't think a lot of investors know a lot about it. And that was one of the reasons that they're saying, what is Salesforce buying here? Or maybe thinking about buying. Tell us about this company.
Sure. Informatica is all about data management, which is about cleaning all the data that comes from different sources and aligning it with the applications and getting all things sorted out for data. So data comes in various shapes, forms, and different sources. So all of that needs to be cleaned up to be used in a proper shape. So I think Informatica is that layer that acts as a cleanser of data and gets you to that right usage. So that's where it comes in as a player.
So if they're not going to tie up with Salesforce, what's the call on this company? What's the call on the stock? Either, bullish or bearish?
Look, strategically for Informatica, such an alliance would have been a great move that would have helped fuel its cloud journey, and that now accounts for roughly 1/3 of its revenues. With the deal not happening, Informatica now has to focus on fueling its cloud growth organically. The company is boosting its partnership and rolling out new AI-powered features, but this space is highly fragmented and competitive. The company has continued to lose market share, especially with the challengers that have risen substantially over the last few years. There are other big players like SAP and IBM that also compete. So I think going forward, the market will definitely look a lot more challenging because now Salesforce not having to go through with this deal will put more resources into MuleSoft, which I think will raise the competitive intensity. And I think that is a big challenge for Informatica going forward.
Anurag, on your side, from the Salesforce side, I mean, is it just steady as she goes? I mean, it's just such a great company. What's the call for the next 12 to 18 months for Salesforce.com?
So Paul, what we're thinking, hopefully by the end of this year, we get a little more clarity on technology spending. And perhaps from next year onwards, we can see that low double-digit growth in sales coupled with some margin expansion, getting you to that mid to high teens earnings growth. That's what we want from Salesforce, organic growth, organic earnings, not so much driven by M&A. And I'm hoping that that's what the company delivers.
Sunil, on the software side, what are the most exciting areas for you that you're looking at here?
Look, for me, in the overall enterprise software space, I still like names in the observability sector.
The names observability?
Yeah,
What's observability?
All right. So the observability is they act as a layer that monitors all of your systems, applications. So be it any kind of an application that you run in your enterprise, everything needs to be monitored if there are like any bugs, if there are like system downtimes, etc. So observability vendors typically monitor all your applications and the infrastructure. So they play a very critical role in the overall enterprise software space. And I think players such as Datadog, Dynatrace are very well positioned
here. Did that
here.
come public recently, like recently, last couple of years?
Yeah, yes, that's right.
So what is, I mean, I love the name. Looking at the stock here, I'm bringing up the stock Datadog. The symbol is DDOG. This thing's got a $40 billion market cap. It's kind of flat stock price on the year, but up 75% over the trailing 12 months. What's the call on Datadog here?
Look, it's a very, I would say it has been a fast-growing company, and of course, last year we have seen a slowdown in the overall enterprise software space, and Datadog, of course, has been impacted with that slow IT spending trends. But overall, if you look at the observability space, as we see, I think that is a space that will continue to grow because the number of applications and the infrastructure that enterprises are deploying, especially with what is supposed to come with Gen AI and others, we will continue to see a massive rise in the infrastructure and applications, and that should all bode well for Datadog and players such as Dynatrace and others in the observability space.
Our thanks to Sunil Rajopal, Bloomberg Intelligence Software Analyst, and Anurag Rana, Bloomberg Intelligence Technology Analyst.
Coming up, we'll break down why pessimism about the U.S. economy may be impacting President Biden's standing with voters.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Molly Smith. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm Molly Smith, filling in for Alex Steele. We move next to earnings from the logistics company UPS. This week, UPS reported first quarter profit that was higher than analyst expectations. This comes as the courier's headcount management and restructuring of its delivery routes begins to bear fruit.
For more, guest host Emily Grafeo and I were joined by Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst. We first asked Lee for his take on UPS earnings.
I think it's really about what they're doing on the cost side. I think that's really the driver of the outperformance in EPS, because revenue did come in slightly lower than expectations on lower volumes. They're dealing with lower volumes from lost share last year when they were negotiating their labor contract, and a lot of shippers kind of try to find other alternatives in case there was an issue with their network from a strike, but obviously that didn't happen. Now they're being pretty busy trying to win back that share. So, net, I think what they're all in all, it was a good quarter. I think if UPS is, meeting or beating expectations, that's a good thing because they've had a rough year, driven a lot by that labor negotiation, which increased costs considerably and resulted in a lost amount of volume, which, for a company like UPS, the deleveraging effect on margins is quite substantial. But there was definitely some good news in the report that, we remain optimistic that they might be even looking to possibly increase, their full year guidance for 2024, especially as the U.S. Postal Service contract, which they recently won from FedEx, starts hitting their P&L.
When you talk about average daily package volume down year over year, revenue down year over year, how much of the softer demand for UPS is related to macroeconomic factors and maybe coming out of the pandemic, consumers shipping less? Is that a factor here?
Yeah, I think it's probably a trifecta of things. It's probably a softer freight outlook altogether. That coupled with tougher comparisons and the fact that they are still trying to win back the share that they lost from their labor contract negotiations. So I think those three things are kind of weighing on their volumes probably more than maybe their competitors like a FedEx or a DHL.
Hey, Lee, I know labor is a big deal with UPS and these companies here. I know UPS, they had a new labor contract that really pushed up wages and benefits starting, I guess, this year. But then on the other side, they also cut 1,200 or 12,000 white-collar jobs. That's like 14% of the workforce here. So talk to us about the labor and the component there and the cost structure.
Yeah, I mean, net, they're doing the right things. The contract might have with the Teamsters might have had a negative impact to margins, but we are going to anniversary those in the second half of the year, so those comparisons won't be as bad. And also, it does provide them with a steady labor force because if your labor is happy, you're going to have less turnover. You have less turnover, you probably have better service and better safety, and that usually yields better profits. So I think if you look longer term, beyond the initial shock of that new contract, which is very front loaded, the increases aren't as bad as we get to year two. It's not going to be as bad. And listen, UPS and FedEx and a lot of these companies, they did get a little on the fat side, if you will, on their corporate ranks. And I think they're both doing the right things in terms of trimming it for the new normal of what their operating environment is today.
How should investors be thinking about UPS?
I think what they need to do is they need to execute. They not only to execute on their 2024 plans, but their 2026 plans. And I do, as I said earlier, I think there is some opportunity for some upside surprise given their U.S. Postal Service contract. It didn't really make that much money for FedEx, but I think UPS's network is very different than FedEx's. It's more integrated. It's not a hub and spoke network, and that will provide them with some profitability. And management is pretty confident, or at least appears confident, that this business is going to be not only accretive to earnings, but accretive to margins. And that's kind of what, we, as we look at the company, really want to see. We really want to see those domestic margins start to improve.
Hey, Lee, what are the companies saying about kind of normalized growth rates in terms of, I guess, unit volume? Where's this U.S. economy in terms of just packages? Is it a GDP kind of number? Is that kind of the story?
Yeah, it's a GDP kind of number, but UPS wants to grow beyond GDP, and how they're going to do that is they've made some pretty significant, not in size necessarily, but in terms of capabilities, acquisitions. They bought a company, Roadie, which it's not a drink on the road, Paul, but it is. What they do is they deliver heavy stuff to people's doors. So think furniture, think workout equipment, fitness equipment, and that is done through more or less an asset-light model, where they're arranging the delivery. So that's a very good business. They're also invested or acquired a company that does returns without having to box it. So it's a lot easier for consumers to either go to a UPS store or one of the other drop points that UPS provides to return something. And that's good for UPS because that stuff goes into their system and it becomes a B2B delivery, where when we say B2B, business, and meaning that there's more density. So they're shipping, they're consolidating and shipping 20 boxes versus just one envelope, and that tends to be more profitable. And then their investments in the healthcare space, their goal is to be the largest healthcare logistics provider. Healthcare has above average margins for transportation companies, given the high level of service that's involved there. Think temperature control, think the fact that it has to get somewhere at a very specific time. So those are higher margin business. So I think that those growth areas I just mentioned will help them grow their overall volumes beyond, just GDP numbers.
Our thanks to Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst.
Now we're going to move to politics. President Joe Biden's recent polling bump in key battleground states has mostly evaporated.
Biden is now trailing Donald Trump in 6 of 7 swing states. That's according to the April Bloomberg News Morning Consult poll. For more on this poll, we were joined by Gregory Korte, Bloomberg News White House and political correspondent. We first asked Gregory for his takeaways from the latest poll.
We've been doing this every month. This is the 7th iteration of this poll in 7 key battleground states. And for the first 5 months, it was a pretty stable race with former President Trump with a slight lead over President Biden. Then after the State of the Union address, we got a little bit of good economic news. And we saw last month President Biden pretty much bring it even. He was winning or even in the Rust Belt states, the blue wall states we call them, of Michigan, Pennsylvania, and Wisconsin. Gave him a fighting chance. But now we're seeing in this month, in the April poll, sort of reversion back to the mean, what we had been seeing all along with former President Trump having across these 7 battleground states, a 6-point lead. And that's significant. Biden can't win this without getting at least those blue wall states and probably another one. And he's now down in Pennsylvania by within the margin of error, but significantly down in Wisconsin. Michigan, interestingly, is his bright spot, and who would have known, because there are a lot of concerns there about a large population of Muslim voters, union workers, but he seems to be holding his own there.
Gregory, what are the key drivers or key influencers in this poll? What kind of moves the numbers around?
It's really the economy, and you see that with any incumbent president. Their numbers move up and down with the economy, and what we're seeing in this poll is deep pessimism about where we're going to be by the end of the year. You see here the numbers. Majorities think that the inflation rate is going to be higher by the end of the year, that the economy overall is going to be worse, and also that interest rates are going to be higher by the end of the year. Now, these are voters talking, and they're sort of giving us their perspective within this political framework, where this might differ a little bit from the University of Michigan survey when we're talking to consumers and people making different kinds of decisions. But the fact that President Biden is so tied to the state of this economy and that people are pessimistic about the economy is not a good sign for the president.
This is so fascinating to me as somebody who covers the economy. Just like this is something, Gregory, we're no stranger to this, but just like the mismatch in like where the economy is actually performing and how people actually perceive it to be performing. And it's so interesting to me that like this mismatch, I guess when you say to me that, that a majority of swing state voters see the economy worsening, I just wonder, like, what metric are they referring to? And I know that they're not looking at the economy based on like, oh, well, we think manufacturing's this, but like what are they looking at? Is it really just inflation?
Yeah, voters look at the economy differently than economists. And one of the interesting things, even in this poll, there's an inconsistency, and it's a little inscrutable, but when you ask people about the national economy, 2/3 of them say it's bad. When you ask people about their local economy, a majority say it's actually pretty good. And so people are differentiating between their own personal economic situation and what they see in the economy writ large. Why is that? It may be because of they're keying off of negative political coverage. It might be because we have this political polarization where when they're saying the economy is bad, they're really trying to make a statement about the president who they don't like. It may just be that they view inflation as a national issue and inflation is high. Unemployment they might see as a local issue because they have a job and their neighbor has a job, and so they might see it as a local issue, and so therefore their local economy is doing well. There's a lot to parse out there, but certainly people are giving us mixed signals about the state of this economy.
What do you think the Biden administration needs to do, perhaps differently, going to Molly's point about saying, hey, the economy is in pretty darn good shape. Here's what we've done. How do you think they should be messaging this?
They have been trying with that message for months now, and it's been a tough message to get across. At one point, they tried to take this pejorative label of the economy that Republicans tried to brand it with, of Bidenomics, and turn that into a positive. That did not work. They did not change the public perception of Bidenomics. They moved a little bit away from that messaging right now. They can talk all they want about the infrastructure bill, the Inflation Reduction Act, the CHIPS Act, all of these things that we know, we've been tracking, is starting to make a difference and will make a difference in manufacturing, onshoring a lot of technology. But those aren't really resonating with people. People don't really connect with bills being passed. They want to see actual stuff getting done. And some of that is on a longer time ramp. So maybe it's just giving it time. We have 6 months now. But the problem for Biden is that now, the second quarter of an election year, is really when people start to make up their minds about the economy, really sort of solidify how they think the economy is, and they're going to carry that with them into November.
Our thanks to Gregory Korte, Bloomberg News White House and political correspondent.
Coming up on the program, a conversation with AstraZeneca CEO Pascal Soriot on quarterly earnings.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Molly Smith. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Paul Sweeney.
And I'm Molly Smith, filling in for Alex Steele. Now we're going to move to the aerospace industry and Boeing. The plane maker said it burned through nearly $4 billion in cash in the first quarter, and its cash use also wasn't as bad as the $4.4 billion outflow that analysts had expected.
But Boeing is still seeking to resolve concerns around the quality of its manufacturing following a near-catastrophic accident on January 5th. For more on all of this, we're joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
We first asked George for his key takeaways from Boeing's quarterly report.
We did see cash burn for 1Q, combined with CapEx, free cash flow usage, $3.9 billion. CFO had sort of told us that we would see something between $4 and $4.5 billion. It came in lighter than that, but you can't live here long, right? I guess the big takeaway here too is that there's about $7 billion in cash and equivalents on the balance sheet. That's dwindling pretty quickly. They paid $4.4 billion, I think it was, in debt during the quarter. So something has to happen, right? They want to buy Spirit Aerosystems. I hear all kinds of conflicting reports, but essentially I think it's, there's a lot of challenges around negotiating getting Airbus out of Spirit Aerosystems so Boeing can buy it. They've talked about using cash to buy Spirit, or I guess debt maybe. I think it's a company that doesn't want to add a lot more debt to their balance sheet. Spirit's market cap around $4 billion. You only have $7 billion left in the balance sheet. Something's got to happen. You got to raise some capital here. You can't do this all cash, or you got to use Boeing stock. And just the numbers they're getting small, right? The cash numbers are getting small. You're running out of runway here. They need to come up with this plan with the FAA and how they're going to stabilize production, start building airplanes, start generating cash, because you can't do this many quarters.
So, George, do you think that there's a risk that we could be hearing about some kind of financing activity from Boeing coming up? I mean, like you just said, I think it'd be kind of hard to envision them doing a debt sale right now. That sounds like a little bit of maybe a red flag to me, but if they would do, I don't know, the equity's not worth a whole lot, what do you do from here?
Yeah, so agreed. I think, what I heard from you is that it could be hard to do a debt deal here. I think so. I think they wouldn't let $4.4 billion get repaid without sort of plumbing the markets and thinking about whether they would do an issuance here. But you wouldn't want to raise equity here. I feel like it'd be hard to raise debt. You got a lot of money wrapped up in inventory on the balance sheet, airplanes that have already been built, haven't been delivered to customers. I think they've shipped some of those in the last quarter, which has freed up some cash. But I think you really got to get the manufacturing, process going again and generating cash. That way, I think that would get folks more comfortable about giving more debt or equity.
I don't know. I could get a debt deal done in this marketplace.
You personally, Paul Sweeney?
Sure. I could go sell some Boeing debt back in the day if I had my seat back.
Maybe.
Some investment grade debt.
Sure, no problem.
All right.
Hey, George, Boeing's customers, the big airlines, what are their needs these days? Do they need more aircraft? Like if Boeing was at 50 or 60% production, would there be demand there for that?
They need more, faster, as soon as possible, I guess. Look, I think if you take United as a, one of the core customers, there's a demand to fleet refresh around the world, right? The new MAX is 15-20% more efficient than the old 737 or the A320. Airlines want that efficiency as soon as possible in their fleets. The market, I think, is looking fairly competitive. It may not, this summer may be a little bit less competitive than we expected given Boeing's problems and some of the geared turbofan problems at Raytheon that knocked some airplanes out of service. But fuel's rising. Airlines want to be very competitive. They need the most fuel-efficient aircraft, so they want them as soon as possible. And like in United's case, almost everybody is increasing size, right? Size of aircraft are rising because pilots got 20% plus wage increases. You got to find a way to drive down costs. One of the things you always do is increase aircraft size, and therefore you're flying more passengers for the same, cost of that pilot up front. That helps you improve efficiencies. They all want it. So they're all trying to find bigger aircraft to fly with more seats. And so, yes, airlines want airplanes as soon as possible. If you're a Boeing customer, what also really ticks you off is you look across the street at the folks flying the Airbus airplane, and they probably have little to no interruption this summer in their schedules. You're worried about what deliveries you're going to get and your ability to fly your schedule, and that hurts if you're the Boeing customer, right? The Airbus customers are smiling.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
We move next to the pharmaceutical industry and AstraZeneca. The company reported profit that beat analysts' expectations. This was due to demand for its blockbuster cancer drugs.
For more, we were joined by AstraZeneca CEO Pascal Soriot. We first asked for his take on the quarterly results.
We had a tremendous start of the year. Actually, our revenue, I should say, grew by 19%. But the exciting piece was that every portfolio of products grew very strongly. Oncology plus 26% to $5 billion for the quarter. Cardiovascular 23%. Rare disease 16% growth. The geographies grew 19% in the US and Europe. The most remarkable was 40% growth in the emerging markets outside of China. And China itself is returning to growth. So really a very, very strong start of the year. And beyond the financials, our portfolio, our pipeline is making tremendous progress. And we started new phase 3 trials, and we announced very positive results, in particular in oncology, which we will present at the ASCO in Chicago very soon.
Yeah, you've got an investor day coming up next month, and it seems like you just said, you're going to discuss the pipeline, including the timing of future treatments and their revenue potential. So can you give us a little sneak peek now for some of us who can't wait?
Yes, exactly. Actually, Marty, thank you for that question. What we're going to try and show to investors is that we can be a strong growth company, not only for the next 7-8 years to 2030, but even beyond that. And so the growth over the next period of time to 2030 is going to be driven by what we have in our hands today and what is going to come out of our phase 3 pipeline very soon. So we're going to attract attention to investors, of investors to the major growth drivers. We're going to show them where consensus is actually underestimating some of our products and the opportunities we have in our pipeline. We have a very large pipeline of new projects, and some of those are underestimated. Beyond that, we also want to show investors what our strategy is and what our plans are for the long term. We've been investing in new platforms, new technologies, which we believe will shape the future of medicine in cancer, immune diseases, and beyond. For instance, cell therapies, gene therapies, antibody-drug conjugates, radioconjugates. Really, this is our goal: show people that we are focused on today, but also tomorrow to 2030 and the long term.
Pascal, I always joke to people, and I say, in my next life, I want to come back as a healthcare M&A banker, because it seems like every Monday we come in and pharmaceutical company A is buying pharmaceutical company B or biotechnology company C. How does M&A, growth via acquisition, fit in with your growth strategy vis-a-vis organic growth that comes from your own in-house R&D?
We identified a number of years ago the technology platforms of the future, as I said a minute ago. So if you look at cell therapy, for instance, we have our own internal efforts, and we've been complementing this with acquisitions or licensing agreements. In particular, we bought a cell therapy company that is bringing us technologies, but also products. And we've been putting all of this together to actually build a portfolio of products in cell therapy, in gene therapy, in antibody drug conjugates and beyond. So we target small to mid-size bolt-on acquisitions. That's really has been our strategy. So we can integrate them much better, and then we can add value along the way before we launch.
Pascal, what can you tell us about drug prices right now? I mean, this is such a sensitive topic here in the U.S., especially in an election year, something that's really close to the heart of so many consumers and voters. I mean, how can you tell us a little bit about the pricing strategy, and are people able to afford a lot of these medications?
It's important, first of all, to remember that in the United States, of course, price is an issue like everywhere in the world, but in the United States, patients have access to innovative medicines that can save their lives much faster than in Europe or in other parts of the world. Innovation is rewarded and access is much faster. Now, price is definitely a consideration, of course. The IRA, of course, has some challenges and some issues we are trying to work to address. But there's also a big benefit for patients, which is that starting in 2025, there will be a copay cap. Patients will not pay more than $2,000 a year who are on Medicare Part D products. And this year it's $3,500 or $600 as a max. So ultimately, if you're a Medicare patient, you will not pay more than $2,000 a year for your medicines, regardless of how many medicines you have and how much they cost. So that will be really an enormous progress for patients. And of course, some of these rebates or that are discounts that are required to compensate for this, we will be paying. But suddenly we see that as a big improvement for patients, and hopefully also an incremental revenue for us, because patients will be able to afford their medicines and take them and stay on them longer. So, win-win, really better for patients and hopefully better for the industry as well.
Pascal, I'm looking at the on the Bloomberg terminal, the PGEO function, which shows me kind of your revenue by segment. And I see that oncology is your biggest revenue line there, about 37% of total revenue. What are the opportunities there in your oncology business? I know it's a competitive business, but what do you have in the pipeline? What do you have to bring to market? How do you think about that business?
Yeah, our oncology portfolio of products grew by 26% in the first quarter to $5 billion in the quarter. So we are on a very strong trajectory, driven by a number of products that we have in the portfolio for lung cancer, breast cancer, prostate cancer, ovarian cancer, and there's more to come. And the future of oncology really is about combination therapy, combination of antibody drug conjugates, as I said before, those products that target the tumor cells and deliver a toxin at the site of the tumor cell and essentially kill the tumor cells without affecting the healthy cells around. And combining this with immuno-oncology products, and then in the long run, adding cell therapy to this. So there's an enormous amount of innovation that's going on in cancer. The biology of cancer is being improved very rapidly, and as a result, new medicines are coming up. There are still cancers, unfortunately, that are difficult to treat. But one of the other aspects of cancer that is very important is diagnosing patients early so you can intercept the disease early. If you look at breast cancer, mammographies have really helped diagnose breast cancer very early, and the survival rate at 5 years is 99% when patients are diagnosed early. Lung cancer is the opposite, diagnosed too late. So there are now technologies that will enable patients and doctors to diagnose cancer very early and treat it early. So the combination of this plus new treatments gives us hope that there is a possibility that in the near future we could actually cure cancer or turn it to a chronic condition that people can live with.
Our thanks to AstraZeneca CEO Pascal Soriot.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg terminal.